All right, I think we're back. The Applied MMT live stream back at it. We'll call this season 3 with Ty. Ty, welcome, my man.
Hey. So this is like the number one MMT live stream on the internet.
The number one,
Number
without a
one.
doubt. Maybe not by viewership, but no, probably by
What?
viewership tonight. We're kicking off like just massive viewers already out of the gate, man. I'm super excited. Everyone, welcome. Chat, say hi. Let me know that you're there, and I am. I'm ready to go. We've got Ty in the house, and we got a lot to talk about. We got a lot to talk about tonight, and this whole new season 3. Season 2 is very short. I think there was a writer's strike or something like that really took out season 2. I don't know.
Well, it's kind of like House of the Dragons. I just found out there's only 8 episodes instead of 10. So I'm pretty disappointed with my HBO subscription because that's the only reason I have it is for House of Dragons. So I get it.
I've never. This is just gonna absolutely. Everyone's gonna leave right at this moment. By the way, chat, if you're there, say hi. I'm not seeing chat come through. It should be hooked up. So let me know, chat, if you are there.
I'm seeing Martin. Martin's in the house.
Well, Martin.
How you doing, buddy?
Martin is saying that he is in fact going to bed. Let's see. Where are we? So to kind of set up season 3. And by that I just mean we're going to do a handful of live streams, Ty and I, where, what's up, Monique? What's up, Derek? All right, we're seeing chat roll through. Yeah, welcome, everyone. Let me set the stage, step back just a moment here. A couple months ago, I reached out to Ty and said, hey, I'm starting to piece together some of this Minsky stuff. Minsky being the application to do system dynamics, economic modeling and system dynamics. And I was struggling. I was struggling to fully model everything. So I reached out to Ty and I'm like, Ty, you gotta help me here. This is kind of an integral part to the bigger process of everything we're building at AppliedMMT, and help me out. And so we got talking, and our talks, I thought, spurred on just some great conversation. I just, every minute I would talk to Ty, I'm like, holy cow, other people should hear this because I'm sure they want to know the sort of questions and answers that we're coming up with. And then furthermore, we've been able to press already using system dynamics and using, kind of the other theory that we have available to us and the various tools that we have available to us. We've been able to really press into, to me, some kind of uncharted territory when it comes to macro theory, when it comes to kind of proving this stuff out. So two things. One, I just want y'all to hear the conversations Ty and I are having as we continue to build this stuff up. And then two, just to kind of show off some of the things that we've been doing. So that's kind of what we're going to do for the foreseeable future here in terms of what we're doing now on the Applied MMT podcast. And I'm just super pumped to have Ty here. Ty, you recently rebranded your YouTube channel. Do you want to say a piece about that too? Just what you've been up to?
Well, I've rebranded myself essentially. So I've been writing a book for the last 8 months. It's called Relearning Economics. I know it's probably a pretty lowbrow title, but I think I wanted to have it accessible to everybody. So that's kind of why the title choice came about. So that's kind of been my main focus. I took a break from social media. I took a break from YouTube, Twitter, LinkedIn, all of it, to kind of concentrate on writing and, of course, my day job, which is day trading. So, making money and paying the bills. So that's kind of where I've been at. So you might still see, if you're using Twitter and you wonder, where did Ty Keynes go? Well, he is now at Relearning Econ. And you might see my tweets out there. Probably a lot of quote tweets. I think that's the way to go. I do a set of quote tweets that are very leftist, and the right gets mad at me, and then I'll do some right tweets, and the left gets mad at me, and that's perfect. That's social media division. That's how you do it.
I like it, man. I like it. Welcome back. Yeah, I think I think in the description of this video, I definitely linked to your YouTube channel, but I'll make sure to also relink to your Twitter. But if you're on my Twitter, X, you'll also see me liking or reposting a lot of Ty stuff. So Ty, welcome back, man. Glad to have you on board. And like I said, tonight the goal here is we have more people kind of stream on in or stroll on in here as the stream rolls on. The goal here tonight really is as the title says, I want to talk theory. I love theory. I've been pleasantly surprised with some of the engagement that I've had in terms of the theory videos that I posted recently. I want to talk theory, but I want to tie that into markets, and I feel like Ty and I together can certainly do that. So, Ty, I'm going to put a chart on the screen. Actually, give me 1 second here, everyone, as I turn studio mode on. All right. I'm going to put a chart on the screen. And what I have on the screen is Django Geek, welcome, by the way. And I think I said Derek, welcome as well, Monique. So, yeah, Django Geek, welcome. What I have up on the screen, I don't know if this is the best measure here. And give me a second, everyone. Sorry, season 3 coming off to a hot start here. All right. What I have... What I have on screen is share of domestic income, corporate profits versus wages paid. And what you end up seeing on this graph, and actually there's a video that I made a while back, maybe a week or two ago too, where I used a similar chart. I think I've got it. Where do I have it? Average hourly earnings, where consistently you see heading into a crisis, you end up seeing average hourly earnings spike higher, right? And coinciding with that and kind of the exact opposite direction is profits. So you end up seeing profits and wages have a negative correlation with one another. And the theory that I laid out is essentially, and it makes, few people pointed out, duh, this is obvious, but I don't think it's as obvious as people understand it or make it out to be. But the question is, why do we see this pattern play out over time? And what are the dynamics that are underneath there? And why does it even matter if what you're trying to do is understand markets? And one of the things, too, that I've been harping on in the last few videos we posted is you have to understand where you're at within the cycle, where you're at in the dimensional space of that cycle, or another way to put it is what part of the system state are we in? And that's really what I'm trying to get at when I'm trying to understand every element of this. At the end of the day, any element of this is just one part of the bigger story that's being told to really just get yourself at an understanding of, okay, are we at the top of the cycle? Are we about to crash? Are we at the bottom of the cycle? Are we just starting up, the big bull run, right? That is what I mean by the various system states. And it's very clear to me by the data that there is absolutely some sort of oscillating, some sort of back and forth between profits and wages, and that is best explained in kind of the holistic system dynamics approach that you and your predecessors and those who've come before you in the heterodox school have really pieced together, and I think it explains it best. So give me your thoughts. I know I just said a lot, but give me your thoughts on what we just talked about. And as you do that,
So what do you really just identify with the first chart? I'm looking at my other screen here. Okay, you're on the wage chart. But with the first chart, you're kind of highlighting something Marx highlighted 120 years ago with the negative correlation you see between wages and profits. He was never really smart enough I shouldn't say smart enough. He just wasn't a math guy.
That's a fair assessment.
Yeah. Try to be nice here. Like, Marx is a great thinker. A lot of it's outdated now, but you can still get some things if you read the classics. But we live in a different world now. But one thing he did identify was the constant struggle between capitalists, or firms, if you want to call them firms or corporations, and workers. And he identified a cycle. And what you just posted in that first graph, the graph you're showing right now, I brought it back up. And I think if you actually were to change that into change over year,
for both,
might even be Yeah, it might even look a little more dramatic,
Oh
depending if
yeah,
you
look at
got
that.
the
Okay, very good. Good
right
call.
data. Yeah.
Oh,
So he had.
chef's kiss.
Okay, I've got a delay on my YouTube feed, so I'm waiting for it to come through. But anyways, I'll assume it looks. Oh yeah, okay, that's beautiful. That's beautiful stuff right there. He identified that. Back in his time before we had Fred data. Now you fast forward 100 years later, we encounter a guy named Richard Goodwin, and for Mark's 100th year anniversary for Capital, Goodwin put together this small model, and it resembled a predator prey model, and this is used in biology a lot to model two species interacting. And he put this model together, similar to the predator prey model, and demonstrated the cycle between rising profits, creating more output, which led to more employment, which led to wages rising, which led to less profits because wages are a cost for the firms. And then the cycle goes into its never ending loop. And obviously, the economy is much more complex than that. But that is, in my belief and a lot of others, one of the underlying factors in the business cycle. So completely endogenous to a capitalist system. Now, obviously, there are exogenous shocks, COVID, um, a war, et cetera, et
Yeah,
cetera. And
yeah.
by no means am I discounting that, but we will always have that underlying cycle, and we should understand what's driving it.
So what I just did is I inverted employee wages just to show that there is a massive correlation between the two if you invert
Yep.
one of them, or a negative correlation when they're not inverted. Now, Ty, what you just expressed was essentially that this is a dynamic system at play here. Derek, looking ahead in the answer book and giving the answer out as that this is the workers are the prey, and in this system. But you're I'm sorry. No, the workers are the predator.
Mathematically in this system, and it's
Yeah.
obviously ethically probably not the right way to frame it, but the workers are the predators
Yes.
in this model. Now, obviously, that's discounting political and class structure, but mathematically, if you were to meld it to a predator prey model, technically the worker's the predator.
So,
and those poor capitalists.
It's music to my ears. Joking aside. Okay, what you're saying though to me, it sounds like you can actually build this out in a system dynamics program, like Rattle, formerly known as Minsky, and that's exactly what we've done here. Little bit about this too. So one of the things that Ty and I discussed is I'm like, hey, I have my own kind of novel theories. I mean, obviously everyone has their own kind of novel theories. And I also know, too, that a lot of the heterodox world hasn't taken the theory that they've built. Just so you guys know, 5, 6, 7, 8 years ago now, I don't know how many years ago, but I remember when I first ran across Steve Keen working with kind of was it called QED, even before Minsky? Was that what it was called? Yeah. So
yeah, it was the beta. Essentially, the different developer was doing it.
But it didn't have what he would end up calling godly tables. It was not stock flow consistent in the sense that
not double entry.
Double entry, correct? Yeah,
it was just single entry. So the genesis of it started there, those tables. But Steve later realized the importance of double entry.
Yeah.
Yeah.
So anyway, I remember all the way back with the QED, and I think he was just starting to develop Minsky. That's about when I ran across him, and I just remember. I was at this point thoroughly convinced of kind of the MMT framework. The government spends, adds net financial assets. Government doesn't spend, it taxes, it removes those assets, and that puts a lot of pressure on the private sector to go ahead and create the credit to continue growth. And then I saw Steve Keen's work, and I'm like, holy cow, these are the dynamics that are explaining what's actually taking place. And what we all kind of understand is the business cycle, right? And that he had definitely the best explanation. For me, the most thorough explanation of what took place in 2008 and the dynamics that took place prior and then subsequent to the great financial crisis. And again, I think I ran across him, I'm going to say 2015, give or take. So it's not like we're at that point way far away from the great financial crisis that was still very much present in everyone's mind at that time. And I was really amazed by the dynamics that were at play, and it just the more and more that I understood how things were playing out, the more and more. Not that I'm an engineer by trading, but the engineer voice in my mind, like it just clicked with everything that Steve was saying in terms of how you explain these flows going through the system, and how there's always these feedback loops that take place and kind of reinforcing loops and that sort of thing that ultimately create the emergent properties that we see play out in the macroeconomy. And I set this stage because I'm like, hey, Ty, it's great that like I get it from the macroeconomy, from kind of like if you're building this for a policy perspective, or if you're building this to just understand the how an economy is going to function as a whole. I have some theories that I think are applicable to the broader picture that come directly from the finance world that I think tell the story in a kind of a deeper fullness, right? So eventually we're going to get to the stuff that we all love to debate. What are interest rates actually doing, right? What is government spending actually doing? All that good sort of stuff. What really causes inflation? What's the effect of inflation? All that sort of stuff. And I think the financial sector can give some very unique, kind of different faceted sort of views on the broader picture, just because the financial sector is now kind of, for better or worse, has become the macro economy on so many different levels. And so I started talking to Ty, and I'm like, hey, if you check out Ty's channel, he recently launched a video on his national model. And I'm like, and he's showing this thing off. And I'm like, look, I think there's some elements that we can add to this, that we can build back up into this. Let's call it the AppliedMMT model. That's a little bit more focused on markets, macro, and kind of the intersection between macro and finance. And so that's what we're doing. But in order to get everything that's going to come in the future, that we're going to talk about in the future, we have to have just the base theory under our belts and have a moderate grasp on that. And so one of the things that I'm like, it's so odd when you sit in markets for so long, all you care about is this finance side. You forget that there's actually an economy. This is so dumb. But the very first thing Ty and I were talking about, he's like, well, yeah, Doug, I'm measuring the output of goods and services being consumed. And I'm like, oh, yeah, that's right. That's what an economy actually is. That's what an economy actually is. I forgot an economy isn't stocks go up, stocks go down. An economy is there's crap being made and people are buying it. I'm being told that the Twitter stream is not actually working. I apologize for those on Twitter who can't watch this anyway. So Ty, let's do this. What's on here is the AppliedMMT model that we created, and this is version 2. We're continuing to work things through, but I've pulled up. And I'm kind of zooming in now on essentially what is the production function, which the essence of this is the Goodwin model. And bringing it back to the Goodwin model in terms of like why this matters. I think it's important to understand from a dynamic standpoint why there is that interplay between profits and wages and what's kind of taking place. So kind of walk us through a little bit of this, and I'll kind of ask the questions that I had asked when we were first kind of kicking things off.
Yeah, so sure. I'm kind of looking at my other screen. So if I look like I'm leaning back doing weird things, it's because I'm trying to.
Ty, what I can do actually to help you out is, can you see now my screen?
Yeah. Okay.
So that's in real time. That's in real time.
You are like a production editor now. You might have a bright future at CNN or something. So what we're kind of looking at immediately is the production function, and we have a variable. I don't know if you can zoom in a couple clicks there, Doug.
Yep.
We have a variable K subscript R, just so you know, the subscript is, the little letter. And that in this simple model represents, all the factories, the machines, all aggregated together. It's constant. We do have a very underdeveloped price structure that Doug and I are kind of working out the theory on right now. But that represents all of your productive capacity. You have a V below, or that would be nu, the Greek letter nu, NU. And that represents your capital output ratio. So essentially it's saying, if you've got 300 widgets of capital, it's going to produce 100 widgets per year. And this model, we dimension the time by year. We could have done quarters, months. It doesn't really matter. We've just defined we're working in per year. So if you move along, then you get Y subscript R. And that is your real output for your economy, the goods available to buy it. And so from that, you can work out, okay, well, what kind of employment does that generate? And so we have a labor productivity, which is right below Y subscript R. And in this very simple model, and we'll probably expand it later to be more dynamic, basically it's a stock that says if there's 100 units being produced, then workers will produce 100 units per worker per year in the stock. And so you take that stock and you divide it with Y subscript R, and you get L, which is your labor. And when I start the initial conditions in this model, each laborer can produce exactly one unit of output. And labor productivity, it's exogenous in this model. It grows at 2% a year, which is roughly what we see in Western economies. And we take that L and we divide it by the worker population, and it grows at 1.5% in this model. And that gives you your employment ratio. And this is where we get to a little bit of the controversial part of the model. It's somewhat of a Phillips curve. And it's not exactly the Phillips curve that the mainstream teaches, which is this binary trade-off between unemployment and inflation. That was never Bill Phillips' actual writings at all. What it is his first of three factors that contribute to the labor force affecting wages. And what this function says is, as labor increases, the employment ratio, so the ratio between laborers and the available pool of laborers, wages will increase. And that was Phillips' first postulate. It was a change between employment and money wages, or nominal wages. It wasn't a binary trade-off between prices and unemployment. So that's fed into that function, and then we can derive a change in prices. And so we go down to, and I should highlight that K subscript R is the prey. We were talking about the predator-prey model. That's essentially the prey species in this model, the capitalist warehouses and machinery. Ethically, again, probably not the correct way to state it. Mathematically, though, that's the way it is. And actually, Doug, if you can just click the play button for a second, just so we get the shape of that function. There you go. And now you can pause it. That's the shape of the wage change function. So as the employment ratio goes up, there's an exponential growth to it. It kind of matches reality. Wages they're sticky downwards. So even when there's low employment, wages aren't going to fall off a cliff. But as you go up that curve, as the employment ratio rises, wages will increase exponentially. And that's only one factor in Phillips' theory. So it's an incomplete representation of the true Phillips curve. And I'm sure Doug and I will work something out a little more in depth as we go along. Doug, you can go down to W subscript L, which is your wage level in this model. So with that function, it develops basically a wage multiplier. So we start this model, and I think it's a one. Now we're into nominal units. Is $1 per worker per year, and it's intrinsically the multiplier created by the function up above is multiplied with that level, which has an initial condition of 1. And that dictates what the wage level, so the average wage level in this simple economy is. And then we want to get to okay, well, what's the aggregate wages being paid in this economy? So we take L, which is the total amount of workers, times the wage level, gives you what firms are paying to households in wages. And then if we assume in this very simple model, and again, Doug and I will change it, we're just assuming that all output is consumed. And of course, in the real world, it's not. The firms carry an inventory, and that inventory fluctuates. Some is exported to other nations. Some sits on warehouse shelves, and some's bought right away. But in this model, we're just assuming right away it's produced and it's consumed by consumers. So what we do is we take Y, the nominal version of Y, and we subtract household wages, the rate of interest firms are paying on loans in this simple model, and the tax amount that firms are paying. Very simplified. That gives us our firm profits. And if we want, now this is the next part. This is where Steve Keen comes in, is he developed an investment function based on Hyman Minsky's work. And this function looks very similar to the wage change function. And what it says, as the profit ratio goes up, firms started taking out, investing more and more, in fact, beyond what they make profits in. So they take out loans, and they're in the euphoric stage of investing because the good times seem like they never end. Austrian economics calls it malinvestment. I think, is it the fourth stage of Hyman Minsky was, what did he call it? The euphoric stage, whatever. So basically what that function says is the profit ratio goes up. Firms are investing more and more and more. We take Y subscript R, which is the real version of output. We times it by the investment function, and we get the rate of real investment back into capital. And that completes that Goodwin loop. And obviously in that loop, we have a rate of depreciation, which is exogenous. So 8% of capital is basically dissolves into nothing. It wears out real capital in this model. So you have that going into K subscript R, which for you math people, Derek, he knows a little bit of math. That's a simple ordinary differential equation. Basically D K subscript R over dt equals F subscript IR minus F subscript DR. Sorry, but no, that's the math. That's the Goodwin growth cycle.
Yeah, that's
and that
awesome. That's awesome.
That generates the cycle that Doug showed in the first graph. That's the theory that Marx established 120 years ago, and then, well, even over 150 years ago. Then Goodwin came along 100 years later and put it into a mathematical form. And it's a great little growth cycle model that can be built out and expanded upon.
All right, awesome stuff. If you're like me, it's going to take you 3, 4, maybe 5 times for Ty to explain this to you before you get it. But he did do that for me. So what I can do is fast forward you to like what, especially if you're like me and you're like, okay, what's the payoff here for markets, and how do we even understand what this even means? Because there actually is a really important payoff here. And the payoff is, by the way, Chad, if you have questions, put question, like spell it out, question, in your question. It'll bring it up on my chat, and then when we get to the end, we'll cover all the questions at that point. Just make sure you put the word question in your question. Interesting too, chat. I figured Larry Summers would be here tonight, but Larry Summers is not. So
That's
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 weird.
so weird.
It's so weird. All right. Why does this even matter? What I'm going to do is all of this outputs a hand. Well, I mean, actually, there are multiple variables that are being calculated at all times. And you can actually, in Ravel, formerly Minsky, you can actually plot those variables. So what I'm going to do is I'm actually going to rerun or continue to run the simulation that we were just running with the variables on screen. And what we're going to do is we're going to go from, okay, Ty, I get this idea. There's some output, and workers create this output along with the initial capital stock, and the companies have to pay the workers, and ultimately at the very end of this, that payment to the workers ends up eating into profits, and that payment has to push higher and higher as employment gets higher and higher. So okay, I'm seeing some dynamics here that kind of make sense. I'm seeing some potential kind of like feedback loops. Okay, I get where this is going. So let's see the dynamics that are playing out now when we look at, out of the income that is being generated, who's getting what, which hopefully we started off with the fact that these two things were uncorrelated or oppositely correlated. So hopefully we see that dynamic play out. And then why does this matter? What's the payoff here? Why should we even pay attention to that? So let's play this out for a little bit longer. And what you're going to see is these get a little bit diminished just because of the scale, but you can end up seeing that over time, and I'm going to hit pause here before this thing completely collapses. Actually, I'm going to play it out and just let it collapse in kind of slow motion. You can actually see the ebb and flow of, in blue in the top left chart, the household share of income. It's never going to collapse, Ty, because I have government spending on. You can see the household share oscillate with the firm share, the business share of income, and they oscillate in a uncorrelated manner as the bank share of income continues to increase. And the emphasis is that eventually in the cycle, wages eat into profits enough that the profit function itself starts to decelerate or starts the deceleration of credit expansion. So one of the things we've been doing with this model, and I forgot that I had this on, so I'm going to go ahead and turn it off and rerun the entire thing, is we turn on government spending and government spending off to show the different dynamics that are at play.
You should actually note that our government spending function is a counter-cyclical function.
So very aggressive counter-cyclical.
Yeah.
So now in this little system, we're going to go ahead and let it collapse. The entire system collapses, and this is the Minsky stuff. We've been over this many times. We're going to go over it in a lot more detail into the future. But eventually the system collapsed. But until that point that it finally collapsed, you get this massive increase of the private debt level as time progresses, and that creates an even higher variance in the kind of sort of volatility between the income shares, and there's kind of ebb and flow between the volatility that takes place. And then eventually the system collapses, where you get yourself into a spot in this investment function because the profits are being so eroded by the higher wage bill that during the boom period, there's this constant, okay, I'm going to take out the next loan to get even more profits, take out the next loan to get even more profits, so on and so forth. That eventually stops when the profits stop increasing over time, right? And that's exactly what this function is trying to say, is when the profits slow down, so too do the loans. And what we see in the data, and we'll go over this in a lot more detail in coming weeks as we continue the live stream, but what we see down the line is it really is this credit cycle that's driving the business cycle as a whole. And once you reach this certain inflection point where wages just get high enough, it's game over until something exogenous comes in outside of the system and replenishes that income. And so all that being said, Ty, if there's things you kind of want to add into that, let me know.
Yeah. So we kind of showed the dynamic between capitalists and firms, and we didn't really show the dynamic how the dynamics created with the financial sector.
Yep.
So what's really occurring there is, yeah, we got our interplay between wages and profits, and if we just had that, it would cycle on forever, so long as there's no exogenous shocks. But in this model, we also added, a lot of Steve's work with the debt level.
Yep.
And so as that private debt level creeps up, not only is the firm having the cost with wages, now it's got this cost, the interest cost, that's slowly creeping up. We're keeping interest rates constant. We're not manipulating them
Yep.
in these model runs. And that's really what causes the ultimate breakdown, is those costs keep going up over time, beyond what the firms are making in a return from capital.
Yep. Perfect. So I brought back up on screen now. So the average hourly earnings comes out monthly, so it's just a little bit more granular. The time horizon, we can get a little more detail in it. And I pointed this out in a video now again a couple weeks ago, where you just end up getting what let me back up. What is it that we're actually trying to solve here? What we're really trying to solve is the credit cycle. And here's why. We want to understand where we are at in the credit cycle. Because if we can understand where we are at in the credit cycle, if we are at the beginning stages of the credit cycle, one of the things we know is that once an endogenous system like the credit cycle has the necessary elements in it, and that's going to be kind of that initial capital stock, the kind of the money in the system to be the assets that are going to circulate from the financial side. Once you have those elements and there is an initial wave of income, which becomes the profits, the thing has all the ingredients it needs to cook, right? It will sustain that growth because of the very dynamics at play in the system. What am I trying to say? When the government spends, and I always use this line, acts as the first profit and the safe assets for the private sector. Private sector has all it needs to go on its own endogenous growth creation, because it can continue to create more money that it needs to consume the goods and so on and so forth. And the question is that goes higher, where are we at in that cycle? Because the reason stocks go higher, the reason any individual stock goes higher, it's making profit, right? And if it's making profit, it's going to go higher. So what is the source of any individual company's profit? What is the source of profit on a macro scale? And very much the entire macro scale is going to follow the credit cycle, because that's going to drive the very elements that investors are looking for in any given stock for that performance to go ahead and then invest in, to ultimately kind of speculate that it's going to go higher. So that's why we care about this. And again, in future weeks, we're going to tie that whole element together, but we got to start somewhere, and this makes sense. And so the point I made is we end up seeing wages push higher. And what that's showing us is when wages are pushing higher to a peak, that means that we're climbing up this investment function. We're climbing up this business cycle. And as wages are coming down or bottoming or crashing, that means we're kind of on the opposite side, right, of the business cycle. That means that the pressure of the costs, the wage costs and whatnot, are relenting. And so now there's space for this credit cycle to start to take off. And so each time into a recession or a crisis, we end up seeing wages fire higher, right? And what we just learned is that that's a very big cost in a system where costs have consequences to the whole system. And so heading into the 91 recession, we saw wages push a lot higher. Heading into the 2001 or the 2000.com bubble, wages pushing higher. Great financial crisis, wages pushing higher. 2022, wages pushing higher. I've mentioned this many times. I think everyone was looking for that recession in 2023. It actually came in 2022. We had kind of a stealth recession play out in 2022. And ultimately, we are now at the very bottom of the cycle. We are where we were at in 2012, similar, more akin to 2012 or 2004 or 1994 or 1987 or something like that, right? That is much more where we are at in the cycle. And so when I talk about where we're at in the system state, where are we at in this dimensional space, that's why this is so important, because we know now that wages are not at this point. I'm going to go ahead and bounce back to Ravel here. We are not at that point where wages are currently an impediment to profits, right? If anything, as wages are really starting to bottom, they are not an anti-impediment. I mean, I don't have a better adjective to describe it, but
Well,
they're,
no, it means lower costs for firms. So
yep,
this is a point. Like we look at the real Fred data at this point, how obviously there is share buybacks, which is problematic from a social perspective. But you have to say because wages are on the lower end of things, a portion of those additional profits that firms then have is going to be rolled into R&D or capital investment, which in the future is going to increase output and increase employment. Which bottom line, at the end of the day, we see a lot of people calling for a recession. The doom and gloomers, the Austrians, maybe, I don't know. Did I say it out loud? But that's simply not the case. We're in the other end of the cycle right now. And this, of course, goes to Doug. We can look at the credit cycle and see some correlations between markets. And that's, of course, what we're trying to work to right now. But we're trying to prove, that our theory of the credit cycle is, correct, and the underlying behaviors behind it are correct, so we can work our way into that.
Yep.
And, we're seeing that in this simple model. We're outlining, okay, what are the very aggregated variables in the system, and does that look the same in the real world data? And which it does. We've put up two graphs here that show the share between profits and wages. Okay, that's pretty high impact stuff. The R value there in that one graph's probably around 0.8, which is pretty good.
Yep.
And then we're correlating that with the credit cycle, which, as you point out, so much has a huge influence on all assets across the economy, financial assets. So what I'm seeing, we're kind of right, about, barring any exogenous shocks, we're about to go into a bit of a upwards trend, maybe in GDP, or it just stays flat. But we're certainly not headed to a recession at this point, barring any exogenous shocks.
Yeah. I can't help if an asteroid hits the Earth. That is outside of my deep MMT model. All right, that's really cool. That was really helpful. Kind of the main points that we wanted to cover, at least in terms of kind of the initial outset. One of the things we'll talk about in coming weeks too is how government spending plays into this. I mean, we're going to spend a lot of time. It's very easy just to troll the deficit fear mongering type, the Chicken Littles that have been out there for a while. It's very easy to troll them, and I have a lot of fun doing it. Don't get me wrong, but at some point there's got to be more value than just pure entertainment to troll them. So we're going to talk a little bit more in coming weeks too, just about the implication of government spending. But I can go ahead and show you right now, just to really drive home this whole point, how important it is that, or what the impact is of government spending, and how important it is that once you get just a little bit of profit back in the system, that you can really get this thing off the ground again. So what I'm going to do is I'm going to go ahead and replay what we have, and kind of right before we hit the crisis, I'm going to go ahead and turn on government spending. And what effectively is happening here, we're about to hit the crisis, so I'm going to turn on government spending. And what's happening here is, maybe I turned it on too late.
Well, now remember what I told you before you ran this model, is now that we've got price dynamics in there, you're going to have to tax out.
Oh, that's right. That's right.
Some of that money, or you're going to have the inflationary spikes.
There we go. All right, so we're gonna tax just a little, but the point is, now at this point, at the very least, we've actually found kind of a more stable system, right? And what you'll see is now private debt is sideways as opposed to continuing to push higher, and the public debt ratio is starting to grow ever so slightly. So the other thing too that we did with this model specifically is unlike, I mean, the automatic stabilizers you have, and well, let me just do this. Let me now take it away. And I think the system does collapse quite quickly. We should end up seeing the debt ratio start to rise, the private debt ratio start to rise, and it will. Then eventually the system will collapse. One of the things that we wanted to do with the system with government spending is really just kind of prove and emphasize, before it completely collapses, I'm going to hit pause here, is just to really prove and emphasize what government spending is doing to the credit cycle and the ability for government spending to go ahead and kind of reboot the credit cycle, if you will, right? Because that was our big hypothesis going all the way back in 2022 was, hey, this rate hike thing is going to throw turned out to be trillions of dollars into the private sector, essentially operating as an automatic stabilizer. Now, usually automatic stabilizers are, you just lost your job because of the recession that just happened, that we just found out why it happens, why there's a wave of unemployment. And so now you go to the unemployment line, you get an unemployment check. That's the automatic stabilizer that kicks in. That becomes the income then that starts this whole system off. We've just decided, it's in fact actually how we're doing it in this system, but we're doing it ultra aggressively. We're not waiting the year lag for the unemployment check to finally make its way through, in terms of the way the whole system ends up working out in reality, where there's a major lag there. Relative to, I guess the point I'm trying to make is, by the time you have to go get an unemployment check and everyone's going in line to get an unemployment check, the game's done. It's a little too late at that point for that automatic stabilizer to not miss out, or to help us miss the recession. This is so aggressive. We're missing the recession. We're actually getting a stability. And so what the government spending is doing is effectively just showing, one of the main points that we've been trying to make is that it's adding the assets, the safe assets, to the private sector, and it's, more importantly than anything else, it's becoming the income for the profits to start to be generated again, to allow the system to once again, kind of have its phoenix moment, come out and rise out of the ashes. And that is what the government spending is accomplishing there. So I'm gonna let this play out, and I think eventually the system collapses. Once again, we should see the debt ratio completely take off here, and eventually inflation will drop. And I think if we go to the phase plots, we'll see employment collapse. Let's see. Yeah, here's the employment ratio, and we're about to collapse on the employment ratio. There we go. So we have the system collapsing once government spending is removed. I will say this too, Ty, and then I'll let you jump back in here. I will say one of the reasons too that there is a cyclicality even to government spending is the government does tax, and as the overall price or the overall level of private debt increases, that actually does just increase the amount of money, and so nominally taxes are going to increase. And taxes, when credit expands very rapidly, that is also going to increase the relative level of taxes that are going to be received, which means that is going to eat into deficit spending, and that will actually then slow down the amount of deficit spending. And we saw this. We saw this play out in 2022 and 2008. 2000 was like an orchestrated surplus, but 2008 and 2022 were not so much. They were just really a consequence of that massively expanding credit cycle at the time. 2022 was also because there were so many delayed taxes because of COVID, but they all hit at once, gets us in this surplus scenario. And the kind of larger point that I'm trying to drive to is the system can create its own deficits as credit just expands at a faster and faster pace, which then kills the deficit spending, which in turn removes the government spending, which allows the system to collapse. So bear in mind too that there's a whole cycle there as well.
So one thing we don't have in this model, and hopefully actually by next week we do have it, you'll see on the tax and spend plot, there's treasury interest. That's government spending. And so in this simple model, the only people holding bonds, well, the central bank can hold bonds, but we didn't do any central bank purchasing. As the banks are holding all the bonds. What we don't have in this model is the banks paying out dividends and wages to the household yet. So this model actually won't collapse next week because there'll be a bunch of interest spending into the economy that'll keep it afloat. It'll be interesting because there's going to be some first, second, and I think even third order delays in the so as Warren Mosler will say, it's highly regressive. Mathematically, it's highly regressive too, because it'll be lagged out so much, kind of like how Doug was saying. We just in this model, we're directly spending into the firms. It's instant profit. We're getting to the point right away to demonstrate something. But when I add the next feature where banks are paying out dividends and wages to the households, we're actually going to see this model keep going. And another thing we're going to add in the next version is really the impact of interest rates being inflationary, because they're adding net financial assets, if they're interest from treasuries, to the economy. And Doug and I are also exploring, and this is where there's a bit of a divide between Keynesian economics and maybe the MMT theory, is what's the true effect of market rates on the private sector, right? Is it inflationary? Could be. Doug's raised some really good points that I'm still trying to learn, and he's a market guy where I'm not, about how, and maybe explain this, Doug.
Yeah, absolutely. Yeah.
The effect of rising interest rates on future contracts.
Yep.
Something where I think Keynesian economics, both new Keynesian and post Keynesian, hasn't explored deeply enough. And to Doug's credit, he's kind of convinced me there's something there to look at. Do I look at it from a micro perspective or a macro perspective? I'm still trying to work it out, but we want to get that in the model to see what those dynamics are.
I know one of the things that I've been one of the things that I have really just been kind of explaining, not explaining, but I have really been trying to, beat the drum about, is this idea that what the Fed is doing is inflationary beyond, by raising rates, or what the Fed did do by raising rates was inflationary beyond just adding that additional interest income. Right, that there could be another element. I'm willing to be convinced otherwise, but I think that what I see when I look at the data empirically is that consistently higher rates lead to higher inflation. At least the statistics that I've ran using all those magical statistical tools, it does seem to be that that it's interest rates go higher, inflation goes higher. Not inflation goes higher, interest rates go higher, inflation goes lower, right? I'm willing to admit the tools are just the tools, and they're not that, they could easily be missing something, and this is it's hard to use certain causality tools in a system that is without a doubt dynamic, and then a complex dynamic, and has chaotic elements within it. So I'm willing to admit there are limits to these tools, but consistently it shows this way, that it's the higher rates are actually causing the inflation. So how does this happen beyond just the interest income coming into the system and boosting prices? And one of the things we've been discussing, and I guess this will be a really good teaser for weeks to come, is that there's this idea that inflation itself essentially drives profit margins, or the demand for higher profits, even higher. And if that's the case, so what I'm trying to say is, let's just say how much profit you're going to want from each widget. Well, inflation is one. Let's say inflation is a scale of 1 to 10, and how much profit you want is a scale of 1 to 10, right? If you want one profit for each widget you make, whatever, and you can come up with it at whatever unit, I'm just trying to keep it simple here, then that one profit equates, or when inflation is at 1, then those are just the same. But what I'm trying to say is, when inflation jumps to 5 on that scale, whatever 5 is, it's not a linear move higher for the desire for profit at that level. It actually is nonlinear. So it might go up to all the way to 10 when inflation gets to 5, right? And so there's this nonlinear connection there. And essentially, what they call it what it ends up being called in the literature is, price gouging sort of stuff, right? But I don't even necessarily think that that's the right way to even frame it, but for whatever, we'll call it that, because I think it's just the inherent nature of a high risk environment or a high rate environment is risky. And so therefore, if you know you've got this inflationary world about to engulf you, about to engulf the nominal world you have to live in, then you have to strive for more profits. So I'm going to be non-judgmental to companies who see the need to reach for higher profits in a higher inflationary environment. The question is, do rates themselves higher rates themselves create that higher inflationary environment the minute rate hikes happen? And I think the answer is yes. And the reason that I think the answer is yes, in just very simple terms, is because of what Ty was just talking about, which is this term structure prices. When a company just doesn't go to the spot market, let's say they need steel or whatever it is, they don't just show up to the spot market that morning and say, hey, I need a ton of steel. They're planning out for months, years in advance, and they do this through future contracts. And if you know anything about discounted cash flow and then present value of cash, you understand that as the risk-free rate goes higher, that diminishes the value of your dollars today and makes future dollars more expensive in relative terms, or in relative nominal terms. And so if that inflation, that kind of inflation price gouging function is true, and what I'm saying is true, that higher rates make the input costs today, even though you're not going to feel it until tomorrow, but the input cost today for production tomorrow more expensive, then in that world, there might actually be a positive feedback loop for rate hikes into inflation, into profits, and then you get kind of this virtuous cycle pushing, well, maybe not so virtuous. Either way, this kind of expanding cycle is part of the expansion that's going to take place. And so that's where we're going. That's what we're trying to figure out with all of this. But I think I'm right. Otherwise, we wouldn't be spending the time on it. But I'm also willing to be proven wrong if it's all said and done. But again, I think empirically we've seen this play out. So in the coming weeks, months, we're gonna figure this out. We're gonna solve it once and for all in the sandbox that is now Ravel. Any other thoughts on that, Ty?
Yeah, no, and I think it's there's sound reasoning, right? So I'm going to try to, model it the best I can dynamically. And that's not to discount, because, the instant argument, and it's a true argument, is rates are a cost, right? So It's a cost to businesses. It means they have less money to invest. We're not arguing against that. I think what's going to be interesting is how does, this kind of theory that, Warren Mosler and you've really taken on, how does that counterbalance that additional cost for firms and households? And how does that change the temporal dynamic in the business cycle, right? So, like I said, I think it's something that's sorely, it's really not understood in Keynesian economics. So it's piqued my curiosity, because I love economic theory and I love all branches of it, right? And I want to take it in, I want to model it, and I want to see how it works. So we're gonna suss that out, right, to see how that theoretically works. And at the end of the day, all this theory is great. Does that theory then match the data we're seeing? And exactly. Then, of course, how can we apply that to AI learning models?
Exactly.
To be a useful tool in the markets.
Exactly. Yeah. If you guys want to know beyond just like the fun of doing this, why we end up doing this anyway. I mean, the whole game, the whole end game for all of this is to always take this knowledge, find the data in the real world empirically, say, yeah, this actually matches up empirically. Once we have that, we really do have the building blocks of everything we need for some really sophisticated deep learning and AI stuff to kind of build forward. So, but we need to validate it in kind of the simulation. And Ty, you use this just great analogy in your national model, and I love it. It's one I know we've thrown around before, but it's this whole idea that like what I like about kind of this whole system dynamic approach and what we're trying to build up here is we're really trying to build a flight simulator, right? I mean, it's really what we're trying to do is build a flight simulator. And so we can, it's kind of like Kerbal Space Program meets Microsoft Flight Simulator meets the macro economy. So we can play around, come up with ideas, test them out, and then see how they're going to play out. And if we can empirically kind of verify them, then we know, okay, we've got the right theory. Now we can start to embed this theory in our deep learning models and get our learning models even more aligned with reality. And that's kind of the key. That's kind of the key end game of all of this. So.
Well, don't you think
fun,
we should?
But yeah, go ahead.
Don't even if it's you can describe it as fun, but don't you think we actually kind of need something like that? And the way I put this, and I'm sure you've heard it and other people have heard it before, we literally simulate the universe and the development and the Big Bang. So why aren't we doing that with national economies? That's beyond me, right? And of course, one of our friends from the other side kind of poked fun at us, last week with a SimCity poster. And I won't mention any names, but he actually wrote a book essentially about SimCity, but that's another story. Aren't we supposed to be doing that? Aren't we supposed to elicit that interest in how the economy is engineered, right? Like that's what we're supposed to do as human beings, right? And we start that through simulation, right, to get a better understanding of the real world. And I think George Box, I think it was his last name, he famously said, all models are wrong, but some are useful, right? So essentially, we're never going to create this perfect representation of a national economy, nor will we of the universe. But at least we can create something where we see the behaviors that we see generalized in economies, right?
Exactly.
And, if we're seeing the same behaviors in the data, then we can say, okay, well, our underlying theory seems pretty solid if we're seeing, the same data, right? And especially with a very complex system like my national model, which is, 600 variables interacting with each other. If you have all those variables and it's simulating the same thing that we're seeing in the real economy, then you have to sit back and say, okay, there might be something there, right? And then if you can say, okay, there's something there, then you can start going to the real data and telling, your learning model, okay, well, this is the theory, these are the bounds, and this is, again, and this is more Doug's area than mine. What was it, Doug, you were calling it, where you bound a learning model to certain constraints? Because I thought that was pretty interesting. I think you should touch on it.
Yeah, so you can, in various learning models, you can essentially put the various constraints on the learning model. One of the things that like they'll do with like models that are trying to learn physics, right, is there's like a conservation of energy, right? It's like a law, and you can embed that theory in the way that the model itself trains, as the model trains and it understands kind of the loss that it's calculating from reality to the function approximation that it's making. You can say, hey, this is reality. Don't go outside of reality, essentially, right? And so, I mean, that's all that we're trying to do. And the only way you do that is with proper economic theory, which I would say we're the only ones that actually have it. By we, not just me and you, but our school of thought.
Mm-hmm. Yeah. Unless you don't believe in math. But that's for the other school.
Correct. Who ironically always say we don't believe in math. I
don't. So essentially what you're saying is we, through economic theory, I don't want to throw this word around lightly, but we're creating some pseudo fundamental constants for the way we understand the economy. And we're going to tell AI, okay, these are the pseudo fundamental constants we've created. Stay within these bounds.
I don't know if I call them pseudo.
Well,
I'm kidding. I get what you're saying. I'm joking. I'm picking on you. I think they're more than pseudo, personally. But yeah.
Okay, but what I'm saying is, so
I get what you're saying.
The speed of light is a fundamental constant, right?
Yeah.
My national model is not a fundamental constant, but it does create some bounds if the theory is right, that we can say, okay, AI, stay within that. And that's fascinating to me. And that in itself is one of the novel things we're doing is we're bringing together complex systems and AI and trying to develop something that's applied. And in this case, the markets. And that's groundbreaking stuff, in my opinion.
Not just in your opinion. I've only ever read one paper that's getting anywhere close. It is using the DSGE model. I think that's what it was using to come up with something similar. And it was published in 2023. And it essentially was like, yeah, it looks kind of cool. I mean, there's nothing applicable there, obviously. Like any academic paper, there was nothing shocking at the end. Well, not any. Some academic papers have something very shocking, but like a lot of academic papers I have, the conclusion isn't, this is groundbreaking stuff. It was more, yep, it seems like it's plausible. So I think I know what we're doing is, we're in pretty rare territory in terms of trying to pull this off. I think we're pretty damn close. So I pulled this chart back up for some reason. I don't know why, but maybe I'll just go back to Ravel and say next week the game plan is we'll go over some more in the AppliedMMT model. We'll probably be up to version 3. We have a lot to add, and we have a lot more to debate. I mean, to me that's kind of the fun of all of this is having these discussions in real time, going back and forth, trying new theories out, trying to explain the theory, seeing if it can end up rigging it up to see if the thing can fly. If it can't fly, then you got to explain, if you still think you're right, why it ain't flying. If it does fly, awesome, but that still might not mean you want to put a human in that plane. And then continue to test it out. So let us know in the comment section if you have any questions, any thoughts, any ideas, things we might be missing, challenges to the theory that we went over tonight that maybe we should elaborate on. I'd love to know those that sort of feedback, and if there's anything else. But Ty, I think we had a lot of success here, and hopefully we teed up the rest of kind of what we're going to talk about with some excitement. I know I'm excited. I'm hopefully there's enough macro geeks out there who really want to dive into this to the level, and then I'll tell you this too. Anything we're going to cover, it will have some immediately applicable. We'll have some immediately applicable payoff to markets and understanding where markets are headed to, and that'll be something that we continue to try to do. So, Todd, I don't know if you had anything else for tonight. Chat. If you all had any questions, let me know before we sign off. But I don't know, Ty. I'm glad to be back. Glad to be back at it.
I'm glad to be back too, like on any live stream. So, I'm gonna be doing a few, right? But this is my first one back, so I was a little bit rusty. I'm a little bit frightened now to think that AI has got its hands on a DSGE model. That's I've never like bought into AI is gonna take over the world and it's gonna be like Matrix. I'm like, yeah, that's I don't know if that's plausible, but when you let AI have a dynamic stochastic general equilibrium model and learn from that frightens me. So for the last 5 minutes, that's been going through my head. Yeah, that's frightening.
I think it's a good thing. What's the worst that could happen? 2008, the DSG models did not really do well. Oh, that's a really good point. Oh, yeah. Oh, I thought you were going to say Terminator.
We don't want to.
2008.
We don't. Essentially, we don't want to type in, chat GPT. Hey, is there going to be another financial crisis? And now it's got all this learned data from dynamic stochastic general equilibrium model. No, we're fine. You're fine. You're fine. Go buy the second house, take out the second mortgage. Everything's good, right? So that stuff frightens me.
That's a really good point. I didn't even think about that. Wow, yeah. That scares me more than Terminator.
Somebody could make a movie about it.
Yeah. All right, chat. It's been a great night tonight. Yeah, if you like this sort of analysis that we do here, head on over AppliedMMT.com. Multiple updates each week. Obviously, markets have been having quite the up and down period. I thought we've been doing an incredible job over there as of late. Other than that, tonight was great. Thanks, Ty. Thanks, chat. I think that's all I got. I'm simply stalling now as I try and find the disclaimer to put up before the stream is over. Chat, thanks for jumping in. Everyone, have a great night. Until next time, good trading, everyone, and we'll talk to you then. Bye-bye.